Can you believe it's already September? That means it's time for another market update. My name is Liz Whittaberry, and I am a chartered financial analyst, and I do retirement planning, including managing retirement portfolios for my clients. So today I want to share just a few things that I am looking at that could help you with your thinking about your retirement portfolio. We're going to run through the market in some charts. We're going to talk about what the Fed is going to do starting this month. And then we're going to talk about something that is on my mind that could be on your mind. I know it's on the mind of many of my clients. So just a quick summary of where we're at. The market is beginning to, the economy is beginning to slow down. The market is actually doing very well, but the economy is beginning to slow down. It is still growing, but it is slowing. And because of that, the Fed has said that they are going to start cutting rates beginning in September. Now, historically, September is the worst month of the year as far as the market is concerned. And so we're going to want to talk about, is the Fed cutting rates going to have a positive impact on the market, or is September still going to be the worst month of the year? We'll look at some pros and cons around that. But let's start by looking at just where are we. When we look at the world markets around the globe, we see that most of them are in positive territory. In fact, there are 3 that were in negative territory last month that have now moved into positive territory, and that is the Brazil, the Jakarta, and France's CAC 40. One thing that is interesting to look at is that the S&P 500 is now outperforming the NASDAQ. So those big tech companies did not do as well this last month, and the S&P 500 has actually caught up with the NASDAQ and is now outperforming it year to date. Looking at the different countries, most of them are also positive year to date, and the U.S. is one of the strongest performers this year. There are a few countries that are outperforming the U.S., but not many, and we have just a few countries that are negative, including Mexico at a negative 21%. So that's the worst performer year to date. Here in the U.S., same as last month, the things that are outperforming are the growth stocks and momentum stocks. So those large cap growth stocks and the momentum stocks are still outperforming. Now, last month, the small cap stocks had moved up, but this month they've fallen back down to near the bottom or at the bottom of their categories. And so that is something that we'll want to continue to watch. Looking at fixed income, we're now at a place where all but 2 categories are positive year to date. And that's the international treasuries and then the 20 plus year treasuries here in the US. Those are longer dated bonds, and so they haven't quite moved into positive territory yet, but everything has gained ground from last month. Everything is 1 to 2% better year to date than it was a month ago. And that is because rates are beginning to come down. And when rates come down, bond values go up. So we're seeing the positive impact of that on all of the fixed income categories. So as I said, interest rate cuts are going to start this month. The Fed has said that they will cut by 25 basis points at their September meeting, and that'll be a positive. It'll be the first time that there's been a rate cut since they started hiking rates back in March of 2022. And if we look back to March of 2022, we see that on the short end, the Fed fund rate was in that 0 to 0.25%. And all the way out at the long end, the 20-year and 30-year rates were at a little more than 2%. The yield curve was normal. It was positive. And what I mean by that is that those longer dated rates were higher than the short-term rates. And that is to be expected. If you're going to tie your money up for a longer period of time, have the risk of not being able to get to it as easily when you need it, have the risk of other things happening along the way, then you're going to want to get paid more for tying it up for a longer period of time. So this is a normal yield curve. Now, from March of 2022 to July of 2023, the Fed raised rates 11 times. And those rate hikes took the Fed fund rates from that 0 to 0.25% up to 5.25% to 5.5%. So a full 5% increase in rates in just 11 hikes in a little more than a year's time. That was a very aggressive rate hike period. And then they just have left it there since then. And we're now all the way to August of 2024, more than a year later. Now, because they did the rate hikes, we ended up with an inverted yield curve. And we see on the short end that our rates are at 5.5%. And then on the long end, it's at 4.2%. So our short-term rates are higher than our long-term rates. And that is what we call an inverted yield curve. It's upside down because those longer rates, where money's going to be tied up for a longer period of time, there's going to be more risk of things happening in the economy and in the market in a longer period of time, then those rates are lower than if you just put it in a short-term bucket right now. And so that inverted yield curve is upside down. And typically when we have an inverted yield curve, we end up with a recession. Now, we have not had a recession yet. They haven't called a recession. The economy is slowing, but it is still growing, and the market is still moving forward. And so there's a lot of thought that we're going to actually end up with what is called a soft landing. That's a very rare thing. It's only happened maybe once, maybe twice in the past. And if it does happen, that'll be a pretty big event to think about. But a soft landing is when we move from this inverted yield curve, this restrictive monetary policy, we get a slowdown, we don't actually go into recession, and then we begin to move back into normalizing and going forward. So we just kind of slow down, but we don't come to as a full recession in that slowdown. We miss getting that big of a slowdown. And so they're thinking that that's possible. We'll see. There's still months ahead of us for us to watch this. But the fact that they're going to start cutting rates in September is a good thing. And that is going to have a positive impact on some areas of the economy and the market. And I mentioned some of these last month. Our small cap companies will benefit from a rate cut because they have a harder time accessing money at a lower rate. So that will be positive for smaller companies. The value-oriented companies will do better with lower rates. Our dividend-paying stocks will do better as well. Anybody that's investing in dividend-paying stocks is going to be comparing what they can get on that dividend to what they could get elsewhere. And so as rates come down, that does make those dividend-paying stocks more attractive. Because the dividend rate is more in line with market rates elsewhere. And of course, dividend paying stocks need to keep some money for maintaining the company and having some company growth. You want some growth in the stock as well. So they can't pay everything out as a dividend. Our rate sensitive sectors will do better. And right now, financials are at the top of the list as far as sector performance. Utilities are right up there with them, and real estate is starting to look better. There are some pockets of real estate that are still very good areas, like our data centers. There are other pockets that are not, like the commercial real estate. And so real estate is beginning to see a positive return, depending especially on the area that is being invested in. It will help increase the market breadth. There'll be people willing to invest in more areas. So that helps with diversification. That helps with the overall market. And then it's going to help our bond values because as rates come down, those bond values will go up. So those are some of the areas that will benefit from these rate cuts. But I want to turn and talk real quick about where we're at currently in our GDP. And especially how interest rates could impact our debt to GDP ratio. The Congressional Budget Office just released, within the last few weeks, I believe, their budget projections for 2024 to 2034. So that 10-year budget projection is showing what they expect the government is going to be spending over that next 10 years. And we do see that the mandatory spending is going to continue to increase over time. We see that they're expecting our defense and our other discretionary is actually going to come down. So I hope they're not being overly optimistic in that area. But then they're projecting that the net interest expense is going to continue to go up. And so having a lower interest rate could help bring the net interest expense down. We definitely want to keep our debt to GDP ratio at a level where we can still have good growth within the United States, and that in the future, we're not creating a situation where it's a slow economy for our kids and grandkids. And so we want to see that be manageable, obviously. When we look around the world, we are number 3 when it comes to debt to GDP ratio. Japan has the highest debt to GDP ratio, and they've been at a very high level for a long period of time. They have a slow growing economy, a slow growing market because of that. Italy is next, and then we're number 3 at 122% debt to GDP ratio. And looking at this chart, you'll see those numbers on the far right, next to the last column on the far right. And I asked this to sort it with the highest debt to GDP ratio, so that we could see where we fell. And we're number 3. Again, if we can bring the interest costs down, that will help with this debt to GDP ratio. The other thing that helps is how fast is our GDP growing? The faster our GDP can grow, the lower the debt to GDP ratio will be. If we can grow our GDP faster than our debt is growing, then that also will help maintain a lower debt to GDP ratio. It's just a formula. And so we want to reduce the one that we don't like, the negative debt part, and increase the one that we do like, the GDP growth part. The Fed now, the Atlanta Fed GDP Now estimate says that for this quarter, they're currently expecting we're going to have 2.5% for the quarter growth in GDP. And you can find this online at the Atlanta Fed's website. They update it in real time. So just a couple of days ago, they were projecting closer to 2%, and they've upped it now to 2.5% for the third quarter, and they will update it as information continues to come in. And so back to September. It is historically the worst month of the year. The question becomes, though, if the Fed starts to reduce rates, is that going to create some momentum for the stock market that offsets the fact that this historically is a bad month? And it is possible that that could happen. Now, we'll want to watch the good news is bad news is good news impact that can happen. Sometimes the market prices in more than what actually occurs. So if the market has priced in more rate cuts than the Fed delivers, then when the Fed actually comes out with what they're really going to do, and it's less than what the market expected, then the market could adjust, and that could create a period where the market just pulls back some. Other good news is bad news is good news could be playing out over the coming months in some of these other areas that we're facing: the election, the geopolitical risk, what the economic indicators turn out to be. And we just had a big economic indicator that is related to our level of employment that had a massive adjustment in what the number was reported a year ago. Now, how it takes that long with all of the computer power that we have, I don't know. It seems to me that it should be much more accurate, much more soon, more real-time numbers because of all the computing power that we have. But it's not. And so when they come back with these adjustments, then we end up having possibly some market reaction to what was actually very old news. We just didn't know it. And so we'll want to watch those things. Now, when you're looking at your portfolio, as always, check your short term, your midterm, and your long term. Make sure that you have the right amount in each bucket so that if you need money, you have it available. It's safe, it's secure, it's accessible. You don't have to, make any changes to your portfolio for the amount of money that you need to spend or the required minimum distributions that you need to take. But then keep your long-term money where it's going to have the growth for keeping up with inflation and meeting your goals 10, 20 years from now so that you stay on track for the long term. I still prefer U.S. equities over international, U.S. large cap companies over other companies, but I am adding some U.S. small caps in looking at the value companies, looking at the cyclical sectors, and looking at bonds and where money is located. What is the duration? What is the yield on that? What is the quality of the bond so that we can take advantage of this change in interest rates to have some improvement in the portfolio, take advantage of the increase that will happen as these rates come down. As always, look at tax loss harvesting and tax gain harvesting, and we're at the end of the year. So in this last quarter is a really good time to look at that and make sure that you've done anything that you need to do to settle any gain or loss for this year. And then, of course, it is September, supposed to be the worst month of the year. So just know that going into it, monitor the risk and volatility, but stay invested for the long term. If you've got a plan and you've got your money invested in those short-term, mid-term, long-term buckets, you're going to be fine. So with that, I wish you the very best September, and I look forward to talking to you again next month.